Welcome to Talk Tickers. We know you want the key takeaways from earnings calls fast, and that's what we do.
Today we're jumping into Oaktree Specialty Lending Corporation, ticker OCSL. This is for their second fiscal quarter of 2025.
Right, our mission as always is to pull out what really matters, save you some time, and make sure you're informed. Let's get straight to the results.
Okay, the headline figures. Adjusted net investment income, or NII, came in at $39 million. That's 0.45s per share.
And how does that compare to last quarter?
It's down. Last quarter was $45 million, or 0.54 cents per share.
Okay, a noticeable drop. What about the net asset value, the NAV?
That also decreased. It went from $17.63 down to $16.75 per share in Q2.
So lower income, lower NAV. What's the main story behind these numbers?
Well, a big piece of it is the non-accrual situation. Those investments have ticked up.
Non-accruals, loans not paying, right? How much do they increase?
They're now 4.6% of the portfolio at fair value and 7.6% if you look at cost. That's up from 3.9% and 5.1% respectively. So yeah, a definite increase there.
That's something investors will certainly be watching. Did they maintain the dividend?
They did. The board approved a base dividend of more 140 cents per share, and they added a variable supplemental dividend too, $0.02 per share.
Okay, so still returning cash to shareholders. Was there any positive financial news? I thought I saw something about their debt.
You did, yes. They had a successful refinancing of some existing bonds, and they also amended their main credit facility.
Good news how? Lower rates, longer terms.
Both, actually. They extended the maturity, which gives them more runway, and importantly, they reduced the interest rate on that facility. That should help on the expense side.
Makes sense. And leverage, where did that end up?
Leverage actually went down. The net leverage ratio decreased to 0.93 times from 1.03 times last quarter. So they've deleveraged a bit, giving them more, dry powder or flexibility.
Okay, let's circle back to those non-accruals.
Yeah.
You said they increased. What drove that? Any new additions?
Yes, 2 new companies hit non-accrual status this quarter. First is Mosaic Companies. They're a tile distributor.
Mosaic, okay. What happened there?
Seems like they ran into trouble selling off parts of their business. Oaktree mentioned tariffs impacting the sale process. They did sell one piece after the quarter ended, got some cash back.
But not enough.
Apparently not. They still took a pretty significant write-down, about 76% on the parts they haven't sold yet.
Ouch. Tariffs causing issues. Who's the second company?
SIO2. They manufacture medical materials. Oaktree had already restructured a loan with them previously.
And now it's on non-accrual.
Right. Due to ongoing cash needs at SIO2, that one was marked down about 69%.
Wow, significant markdowns on those two. Any other moves in the non-accrual book?
Yeah, there was another one, Dialysis In, which was already on non-accrual. It saw an additional markdown, quite large, around 76%.
So more pressure there.
Yes, but it's worth noting they pointed out that those two positions, SIO2 and Dialysis In, combined, are now less than 1% of the total portfolio at fair value. So the impact is contained in a way.
Okay, contained impact now. Was it all bad news on the non-accrual front, or was there any progress?
There was some progress reported. They fully exited their position in SVP Singer, consistent with how they'd valued it before.
Okay, one exit.
And they mentioned increased sales activity at Avery, that luxury building project they have, which was also on non-accrual. Plus, post-quarter end, in April, they received nearly $100 million in repayments on other debt investments.
At par.
Actually, at slight premiums, which is positive.
Good. Okay, let's shift gears to new investments. What kind of activity do we see in Q2? Was it busy?
Actually, deployment was quite a bit slower this quarter. They committed $47 million in capital.
$47 million. How does that stack up against Q1?
It's way down. Q1 saw them deploy $198 million, so a big difference.
Any reason given for the slowdown? Market conditions.
They didn't explicitly state one reason for the slowdown in deployment itself, but we'll get to their market outlook later, which might provide context. $47 million went across 32 investments, though.
More deals, just smaller amounts.
Exactly. 24 were new companies, 8 were add-ons to existing ones. So the increased diversification portfolio now has 152 companies, up from 136.
And the yield on these new loans, still attractive.
The weighted average yield was 9.5%, just a touch lower than the 9.6% in Q1, so still in that mid-nines range.
What about the profile of these investments? Still focused on senior debt?
Very much so. About 84% of the total portfolio is in senior secured loans, and within that, 81% is first lien. That's the top of the capital structure, generally safer.
Are they still lending to larger companies?
Yes, that trend continues. The median EBITDA of their portfolio companies actually increased to $158 million.
So bigger, maybe more stable borrowers?
Yeah.
How's the leverage on those companies looking?
Overall borrower leverage held steady at 5.4 times EBITDA. Interest coverage, though, dipped slightly to 1.8 times. Still covering payments, but a bit tighter.
Did they highlight any specific new loans?
They mentioned a couple. One was a $61 million piece of a loan to Vantif, that's in dialysis equipment. Rate there is SOFR plus 5%. And another was $15.5 million to Barracuda Networks, cybersecurity, at SOFR plus 6.5%.
Got it. What about the other side of the coin, exits and repayments? You mentioned deployment was slow. Were exits slow too?
Yes, exits also slowed down. Total proceeds were $279 million. They said this was mainly because they sold fewer liquid assets from the portfolio compared to the prior quarter.
Okay, fewer opportunities maybe in the public markets to sell into.
That seems to be the implication, yes. Less favorable conditions for selling those more liquid holdings.
Let's zoom out to the overall financials again. We talked about the lower investment income. What caused that specifically?
Three main things. One, just having a smaller average investment portfolio size during the quarter compared to Q1. Two, the impact of those new non-accruals not generating income. And three, just declining reference rates like SOFR.
Right. Rates coming down slightly impacts floating rate loans. What about expenses? Did they manage those?
Expenses actually decreased. Net expenses were lower. Lower interest expense was a driver, partly due to having lower average borrowings and partly those falling reference rates again. Also, the incentive fees paid to Oaktree were lower because of the total return hurdle mechanism.
The fee structure working as intended, and their overall debt. How much do they have outstanding now?
Total debt stood at $1.47 billion. The weighted average interest rate on that is 6.7%.
And the mix between secured and unsecured.
They've shifted more towards unsecured. It's now 65% of their total debt. That generally provides more operational flexibility.
And liquidity. Do they have cash available?
Seems comfortable. They reported about $1.1 billion in available liquidity between cash and undrawn credit lines. Against that, they have about $273 million in unfunded commitments to borrowers.
Okay. What about their joint ventures? How are they performing?
The JVs seem to be doing okay. They hold about $440 million in investments. The aggregate annualized return on equity for the quarter was around 10.6%.
Decent return.
And leverage in the JVs. Pretty modest, about 1.3 times. They also mentioned receiving a small dividend, $700,000 from one of the JVs during the quarter.
All right, let's talk about the market. What was Oaktree's take on the current environment and the outlook?
They definitely acknowledged increased volatility, especially in the public markets after the quarter ended. A lot of that seems tied to uncertainty around trade and tariffs.
Tariffs again. Seems like a recurring theme.
Absolutely. Their expectation is that M&A activity, which drives a lot of lending opportunities, will probably stay slow until the economic picture gets clearer.
And for lenders?
They anticipate lenders generally being more cautious with deploying capital right now.
What challenges are companies facing, according to Oaktree?
The trifecta, really.
Yeah.
Tightening liquidity, rising borrowing costs, even with recent dips in benchmark rates, spreads might widen, and ongoing supply chain disruptions.
How are they thinking about the tariff impact on their own portfolio?
They said it'll probably take a couple of quarters for the full impact to really show up, but they're being proactive.
How so?
Mentioned actively selling investments where they perceive higher tariff exposure and continuing to focus on diversification.
Any potential upsides in this environment?
Interestingly, yes. They highlighted that increased stress could lead to more demand for rescue financing. And that's a space Oaktree, with its distressed debt background, is well equipped for.
So a potential opportunity amidst the caution. What's their overall positioning message?
They believe they're well positioned. Strong balance sheet, focus on senior secured in larger companies, experience in navigating tricky markets. They think they can deliver attractive risk-adjusted returns despite the headwinds.
Okay, so summing it up for someone tracking OCSL, what are the key things to take away?
Well, you can't ignore the rise in non-accruals and the hit to NII and NAV this quarter. That's clearly a negative data point driven by specific troubled investments.
So on the other hand,
they took positive steps on the liability side of it. The refinancing, amending the credit facility, and reducing leverage gives them that flexibility we talked about. Plus, their focus on larger, potentially more resilient companies could be a benefit now. And the market commentary itself is important context to the tariff concerns, the M&A slowdown expectation.
And the JVs continue to contribute.
Exactly. It's a mixed picture, definitely some challenges, but also some proactive management and potential opportunities.
Okay, that brings us to our This Is Not Financial Advice segment. We like to toss around some, let's say, creative ideas based on what we've heard. Given the volatility, the tariff talk, Oaktree's interest in JVs, what's an outrageous but plausible idea?
All right, keeping firmly in mind this is just speculative thinking, not advice. Here's one possibility.
Let's hear it.
Idea number one. You could consider looking at a basket of broadly syndicated loans, maybe focusing on sectors similar to what OCSL holds in its JVs. The thought is, if market dislocations happen, maybe driven by tariffs or other worries.
Oaktree might step in.
Right. Oaktree might see value, maybe even lever up the JVs slightly, and buy those discounted loans. So a long position in those types of loans anticipates Oaktree potentially becoming a buyer and driving returns. It banks on Oaktree having the capital and seeing value there.
Interesting. Playing ahead of their potential moves. What's another idea?
Idea number two. Maybe a pairs trade within the BDC sector itself.
Okay, long OCSL, short.
Exactly. Go long OCSL, betting on their management experience, their focus on larger companies, and maybe their ability to capitalize on rescue financing deals.
And the short side.
Short a pure BDC that might have, say, more exposure to smaller companies or businesses perhaps more directly in the crosshairs of those tariffs we keep mentioning. The thesis is OCSL might outperform relatively if the environment gets tougher.
A relative value play within the sector. Okay, definitely food for thought there. But again, folks, these are not recommendations, just thought experiments.
Absolutely. Do your own homework, always. That pretty much wraps up our deep dive into Oaktree Specialty Lending's Q2 call.
We've hit the key numbers, dug into the non-accruals and new deals, heard their market view, and kicked around some speculative trades. What stood out most to you from this?
Yeah, what questions does this raise as you think about OCSL or the broader private credit market?
Let us know what you think. Join us next time on Talk Tickers, where we'll break down another earnings call to bring you the insights that matter.